Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Steve Sosnick, Chief Strategist at Interactive Brokers, to discuss if investors are less risk-averse, truly complacent, or de-risk their holdings sufficiently to require less hedging through options. Steve, it's great to see you. As always, explain to us what you're looking at in the options market and why you think there could potentially be some complacency here.
Hi, Jill. Yeah, what I'm looking at here is just sort of the volatility measures that we most commonly look at, really sort of backed around their lows for the year. And we could go across a different range of measures, whether it's VIX, whether it's vol-Q, whether it's the relationship between vol-Q and VXN. We can, I'm sure we'll talk about a bunch of them, but we can basically see that these are all starting to calm down to levels that we really haven't seen in a while in terms of lows. And it makes me wonder why. What are people so are they complacent? Have they de-risked, as you noted in the opening? I think it's some of each, but I'd like to try to unpack that with you as we talk over the next few minutes.
Yeah, because fundamentally, there are a number of factors out there. Any single one of them could potentially throw a wrench in the market. But Steve, your first chart here, you're looking at vol-Q versus NDX. What do you see there?
Yeah, well, what we see here is vol-Q, which, just as sort of everybody remembers, is the basically it's a volatility measure trying to get the market's best estimate of volatility over the coming 30 days. But unlike VIX and VXN, vol-Q uses at-money options rather than sort of all the various options with a similar mature time to expiration, I should say. And we see here that in the chart that vol-Q is pretty much at lows. The chart is inverted, so it's an inverse chart just to sort of make it stand out a little better. So up is low and down is high, and we see that vol-Q is pretty much near its lows for the year, but NDX is nowhere near even bouncing back toward the top of the trend line that it's been following in. So that tells me that markets may be a bit ahead of themselves in terms of anticipating a lack of volatility over the coming 30 days. Now, there are some seasonal reasons for it. December can be a slow month. We did get through Thanksgiving. We're starting to incorporate the Christmas season, which is typically, as we know, a slow period. But we do have a Fed meeting in there. We do have payroll numbers on Friday. So just the idea that there's no volatility coming over the next 30 days or very light volatility, that may be a bit of a stretch. And I think that's kind of what I wanted to point out here with that chart.
And if we look at your other chart here, you're looking at the S&P 500 versus VIX. Are there any differences there?
Yeah, the difference there basically is that I would say that the divergence between vol-Q and NDX is a bit more extreme than the divergence between VIX and SPX. Both are, what I'm going to say, similarly out over their skis to a certain extent in terms of, back toward low levels. VIX, we've had this flirtation with the 20 level, but NDX seems to be a bit more toward its year lows than SPX, over recent weeks. There's definitely reasons for it. The Apple news today hasn't helped. The underperformance of Tesla hasn't helped. And so I think you've got a couple of other factors that are sort of impeding NASDAQ a little bit. The takeaway from that is, if you're betting on a bounce, as we've said before, if you're trying for a trade, NDX is usually a better way to play it than SPX because it tends to move in the same direction, only with more volatility. So if you get it right, you can often find that you have an outsized move. On the flip side, if the markets are kind of wrong, that means you may want to shy away. So you really have to take your pick as to which side of the trade you want to be on.
So if you think about strategy, though, with volatility being this low, I mean, it almost seems like it makes sense to put on a cheaper hedge here if you have the expectation that we could see some fireworks into the end of the year.
Yes, absolutely. The time, I always used to say, we were selling, when I was an options market maker full time, to a certain extent, we were selling parachutes, and no one really wanted to buy a parachute when the skies was not turbulent. Then all of a sudden the plane would hit some turbulence and people would be curious about what the price of parachutes might be. We could extend the analogy, umbrellas, whatever else. But the bottom line is, the time to be considering protection is when it's cheap, not necessarily when it's expensive. When it's expensive, it means everybody's clamoring for that same volatility protection, and you can wind up overpaying. You can argue that, if you're buying insurance, well, what if it doesn't pay off? Remember, when you think about it this way, if you're buying insurance, you don't always want it to pay off. right? I have homeowners insurance. I really don't want it to pay off, but I pay those premiums nonetheless. And so, you extend that analogy. If you're buying insurance on your portfolio, on your holdings, now is the time to do it because the premiums are lower. It's relatively cheaper to do that. And, if you're truly pessimistic, well, then maybe you should rethink your strategy altogether, and maybe lighten up on stocks, which is partly going back to why I think we see some of the volatility measures a bit reduced, because I do think that there has been a lot of institutional portfolio managers who've de-risked. So they're not needing to purchase insurance to the degree that they did before, which reduces the price of that insurance. And that's reflected in the volatility measures that we discussed.
All right, Steve, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.